Money laundering is the process of disguising the illegal origin of earnings and making them appear legitimate. Essentially, it's about cleaning dirty money to integrate it into the legal economy. This process allows criminal organizations to transform profits gained through illicit activities such as drug trafficking or fraud into funds that appear to be earned legally. By laundering money, they can invest these earnings into legitimate ventures or make significant purchases, like luxury cars, yachts, or properties, without drawing suspicion from law enforcement or financial regulators. Experts studying this complex phenomenon identify three key stages in the money laundering process: placement, layering, and integration. Placement is the initial step, where the dirty money enters the financial system. Layering involves moving and disguising the money through a series of transactions, making it difficult to trace its origins. Integration, the final stage, creates the appearance of legitimate income, allowing criminals to safely use their funds without raising red flags. There are countless methods used to carry out these stages, but here are the 7 most common strategies employed for money laundering today. Using cash-intensive businesses. For the placement stage, criminal organizations often rely on cash-heavy businesses, such as restaurants, bars, or retail stores, to launder money. These establishments naturally handle large amounts of cash daily, making it easier to mix illicit funds with legitimate earnings. By inflating revenue figures or falsifying sales records, criminals can disguise their dirty money as part of the business' legitimate income. This method is particularly effective because it blends seamlessly with regular business operations, making detection much more challenging for tax authorities and regulators. Number 2. Smurfing. Another common placement method is smurfing, where criminals use multiple individuals or smurfs to deposit small amounts of illicit cash into various bank accounts. These deposits are deliberately kept below the threshold that would trigger mandatory reporting to financial authorities. By breaking down large sums into smaller, seemingly innocuous transactions, criminals can avoid suspicion. Once the money is in the banking system, it can be transferred between accounts, funneled to shell companies, or sent offshore, entering the broader financial system without drawing attention. This method requires careful coordination but is highly effective for bypassing standard banking controls. Number 3. Complicity of financial professionals. During the layering stage, laundering large sums of money often requires the cooperation of professionals within the financial sector. Corrupt bankers, accountants, or financial advisors can use their expertise and access to help their criminals move funds through a complex web of transactions. These professionals can create fake documents, manipulate account records, or exploit legal loopholes to obscure the money's origin. Their involvement adds a layer of legitimacy to the process, making it harder for authorities to trace the funds back to their illicit source. This method is particularly dangerous because it undermines trust in the financial system. In recent years, cryptocurrencies have become a favored tool for money laundering. Digital currencies like Bitcoin, Ethereum, and Monero offer anonymity and decentralized transactions, making them ideal for hiding the origin of funds. Criminals can create anonymous blockchain wallets and transfer money globally without leaving a clear trail. Some cryptocurrencies, such as Monero, are specifically designed for privacy, making them even more appealing to those seeking to evade detection. Although regulatory efforts to monitor cryptocurrency transactions are increasing, the technology's decentralized nature continues to pose significant challenges for law enforcement agencies. Number 5. Casinos. Casinos have long been a go-to method for laundering money due to their high cash flow and lack of scrutiny in many jurisdictions. Criminals can purchase chips with dirty money, gamble minimally or not at all, and then cash out their chips. The funds are returned as clean money, often accompanied by receipts stating their gambling winnings. This approach can also be combined with layering techniques to further obscure the fund's origins. Casinos are particularly effective because they provide a plausible explanation for large cash transactions, making it difficult for regulators to identify illicit activity. Number 6. Art and real estate. High-value assets like artwork and real estate are ideal tools for money laundering because their valuation is subjective and often fluctuates based on market demand. For example, criminals can overvalue or undervalue a painting or property during a transaction to justify the movement of large sums of money. These assets also provide a legitimate cover for transferring funds internationally or between entities. In addition to being a status symbol, artworks and properties can be easily stored, resold, or used as collateral, making them versatile instruments for laundering money on a large scale. Number 7. Shell companies and offshore accounts. Shell companies and offshore accounts are classic tools for both layering and integration. Shell companies are legal entities with little or no actual business operations, created solely to hold and move money. Offshore accounts in tax havens with weak financial regulations provide a haven for hiding illicit funds. By routing money through these entities, criminals can create a complicated paper trail that obscures the true origin of their funds. These methods are particularly attractive because they allow for large-scale money laundering with a veneer of legality, making them difficult to investigate and prosecute. Money laundering is a sophisticated and evolving process that adapts to changes in technology and financial systems. As governments and financial institutions strengthen regulations to combat it, criminals continually develop new strategies to bypass controls. Understanding the most common methods used for laundering money is critical for identifying vulnerabilities in the system and implementing effective countermeasures. This global issue highlights the need for increased vigilance and cooperation among financial institutions, regulators, and law enforcement agencies. Money laundering doesn't just harm financial institutions or enable criminal organizations. It has widespread consequences for entire economies and societies. By infiltrating legitimate markets, laundered money distorts competition and undermines fair business practices. Companies backed by illicit funds often operate with an unfair advantage, driving out honest competitors and creating monopolistic behaviors. Moreover, the unchecked flow of illegal money destabilizes financial systems, as large unexplained cash movements can cause market fluctuations and erode trust in economic institutions. What do you think about the current measures to combat money laundering? Share your thoughts in the comments below. And don't forget to like, subscribe to the channel and hit the notification bell for more videos like this. Thanks for watching and see you in the next video.